On today's hot sheet, I'm discussing Fannie Mae's updated mortgage rate forecast and Redfin's report on pending sales in December, plus what it would take to return to pre pandemic levels of housing affordability. Today is Friday, January 19th, 2024. I'm Byron Lazine, and the hot sheet starts now. Welcome into this free format Friday. Love to know which market you are tuning in live from as I sit here in my Naples, Florida studio. If you want to get the most out of what we do at BAM, join BAMX. Use code HOT to get 10% off of BAMX, where you get access to all of our show notes, all of our daily downloads, live streams, courses, as well as the community. Go over to BAMX and use code HOT to get 10% off for that. It's a free format Friday, so I'll be taking any questions you want to drop into the comments down below. Haley will help me with those questions, get those posted so I can answer them. It's free format Friday, so I'll bounce around if I have to. We do have a few topics here to share as well. First one being the updated mortgage rate projections from Fannie Mae. Let's see if they are on the bull side or on the bear side for mortgage rate projections. I just want to say this before we dive into their projections. I've been seeing a lot of content right now about this 5% interest rate. I mean, it made sense that everybody was all giddy the end of December. Oh, 5% rates are coming soon because we had such great momentum the end of December. And when we did the end of the year forecast, I just believed we've been watching it on the hot sheet all year leading up to this point. And I'm like, there's going to be some more bumps in the road. So when we set the over under on Knowledge Brokers podcast at the end of the year for over or under 6.375, I took the over. We've been sitting obviously over that 19 days in, very short time frame, small sample size. I get it. But you see what the 10 years done today. I mean, the last 3 days in a row where it's gone up. And, yesterday we basically ended out at 6.9. And so this theory that we're going to be with certainty into the fives, I think can be dangerous advice for some folks, because we know that listings right now are starting to loosen up. We can see that in the inventory and the new listing data. We also know that this time of year is often for a buyer less expensive on the price tag than it is in April. And so if we're pounding the chest about 5% interest rates in 4, 5, 6 months, are we making it more unaffordable? We're going to talk about affordability here today. More unaffordable for those buyers that say, well, I'll just wait for that. Prices go up in that environment. And so I'd still encourage folks to, if they're in the game, if they're a real shopper, to be considering all things on the table now, because there's no guarantee. Nobody has a crystal ball about where prices are going, all right, or about where rates are going. And there's more uncertainty, I think, now than there was on December 19th. That's for sure, from what I'm seeing. All right. Don't know if that froze on your end, but looks like I'm back, so that's good. All right. So the January economic housing outlook from Fannie Mae does show an updated projection for 2024 housing market, including an expected decline in mortgage rates below 6% for 2024. So Fannie Mae is jumping on this train. And I don't want to get confused here. I want sub 6% rates. I'm rooting for them. I want them. I'm not guaranteeing them is something I'm not going to do. Anticipation of more typical pattern in housing and mortgage markets in 2024 after turbulent market in recent years. All right, so here's their projections. Anticipation of 30-year fixed rate moderating below 6% by the end of 2024. I'm hearing a lot of people say by the end of the first half or by the halfway mark. And when they say fives, it sounds like 5, right? So I think we got to start being clear on that. A 5 handle could be 599, right? Sounds better than 6. I get it. Financial markets interpreted the December Federal Reserve meeting as a pivot toward a more neutral monetary policy stance. There's some grumblings. We talked about it yesterday on the hot sheet. The Fed might be doing a little bit of flip-flop on what they're saying. All right, so here's the forecast. Quarter one Quarter one, Fannie Mae now at 6.4%. This will be right out of the show notes, so it's available for BAMX members, okay? Quarter one's at 6.4%, previously at 7%. And these are great. If you see even what we're doing at Now BAM with some of the show notes, just posting and showing how you can use this stuff, it's been a great hit on social. This whole post right here, you could copy and paste this if you're looking for some social content. This whole section right here, you copy and paste quarter one, quarter two, quarter three, quarter four, and have a great post. So quarter one, 6.4%, quarter two, 6.2. That was previously 6.8. Quarter three, 6.0%, previously 6.6. And then they have quarter four, 2024 at 5.8%. That was previously 6.5. Now, I'd love for this to come true. It would definitely mean my over-under for the year of over 6.375 would be wrong. You have 3 quarters under 6.4. That's going to come up as a wrong projection. And so I'm rooting for Fannie Mae there on their projection. They're taking this is more of a bull side here for sure from Fannie Mae. Okay. Interest rates have fallen sharply since the peak ending in October. But you also see that that's correlated with the 10-year falling. And we know what the 10-year has done the last couple days here. We can also get a falling 30-year if the 10-year and the 30-year spread normalizes to what we've seen in the past. Okay. Some more information here. About 90% of outstanding Fannie Mae loans have a note rate below 6%. Okay. So outstanding Fannie Mae loans, 90% are below 6% level. So another trend that we've been following pretty closely there. It's kind of attributed to that lock-in effect over the last year and a half. Employment surveys are mixed, contributing to heightened uncertainty. The people think that number we gave out, was it yesterday? I think it might have been either yesterday or the day before. You can go back and take a listen if you've missed any of these hot sheets this week. But that number that we gave where you saw unemployment in the lowest level in quite some time is a good thing for the economy. Typically, it is. Typically you don't see recession without unemployment going up. But in the fight against inflation, they want just enough of it. Okay, they want just a little bit of unemployment, and they're not getting it. Okay, they're not getting it at all, and so it's actually a concern of the Fed that we could reheat up in inflation because of that. Here's actual unemployment rate, and the current forecast is down off of the prior forecast. I think my head's blocking that. I'll move that up. Okay, the current forecast again is below the prior forecast on unemployment, really just showing a flat line of unemployment. Job market extremely, extremely strong. This is making the Fed's job harder, not easier, which then we get into the debate. Well, are they really going to cut at the end of quarter one, quarter two, like they alluded to in middle of December? There's some rumblings this week in financial news that they're rethinking that. They're hesitant about that. That's going to push a little bit of a higher for longer conversation back into the forefront. End of December, we were talking about rates. Oh, higher for longer is done. Here we go. I said, I think there's going to be some bumps in the road, and we'll see how these next couple months play out. I hope I'm wrong that there's going to be more bumps. We've seen bumps all of January so far. It hasn't just been a smooth sail downward trend. That's for sure. Let's go into some of their sales projections. They've got housing starts. We already did that with NAHB. We don't need to cover that again. We'll go. Let me just see if there's anything missing that I want to cover with them. Fannie Mae, that is, on their projections. Unfreezing of existing home sales market. Okay, this is something that let's take a look at. The existing home sales market was hindered, obviously, with the strong lock-ins, but the increase in home sales is forecasted for an increase in home sales is forecasted for 2024. So another projection that's saying, hey, we've hit the bottom now in total sales. I do believe the bottom on interest rate is behind us, meaning the bottom being the high mark, the 8% mark. I believe that's behind us. I just think there's a bumpy road to get down to where we want to go. A little bit of more volatility. This sales, it appears with all projections, it appears early signs here out of the gates in 24 that total sales bottom is behind us. Those are really good things for a strong market. Sluggish pace of existing home sales expected to improve with successive quarterly sales increases in 2024, according to this updated Fannie Mae report. They expect strong new construction. We covered that with NAHB the other day. Home prices ended 2023 with a 7.1% growth, according to Fannie Mae, on a Q4 over Q4 basis. Anticipation of moderating home prices due to factors such as unfreezing of existing home sales and increasing supply of new homes. So, like almost everybody else, calling for a little bit of bump, not anything crazy. Meaningful growth in single-family mortgage originations. We've also seen this reaching $1.98 trillion with an expected increase to $2.44 trillion in 2025. Single-family refinance originations are projected to also grow, and we've actually seen that in the data here recently. That single-family originations are growing currently. Okay, here's the exact table from Fannie Mae. That will drop into BAMX as we always do. They do have housing starts the same every quarter this year, and they actually have it increasing housing starts into 2025. Again, total home sales every quarter going up, and then in 2025 they have total home sales going up as well. That's this line right here. This is total home sales. So they have seasonally adjusted basis of 4.6 plus million, excuse me, in 24 to almost 9 million, then to 5 million, quarter three, 5.2 million, ending quarter four, 2025 at 5.8 million seasonally adjusted total home sales. So great numbers there. Existing home sales, because that includes new existing home sales, they have us just over 4 million for this quarter, seasonally adjusted. Last quarter, fourth quarter, we came in at just over 3.8 million. So just over 4 million on existing, 4.1, 1.63 quarter two, 4.324 quarter three, 4.464 quarter four. And it's not until quarter five for existing home sales of 2025 does Fannie Mae project existing home sales to be up over 5 million mark. Okay, that'll be again available for everybody. Easy to download inside of BAMX. Pending home sales, according to Redfin, have risen 4% in December. It's the biggest jump in over 2 years. This might be one of those leading indicators that we are truly going to get off of the bottom of total home sales here and leave that behind, that 3.8 number that we just talked about, leave it behind in the fourth quarter of 2023. Home buyers came out of the woodwork as mortgage rates posted the biggest monthly decline since 2008. We've lost a little bit of that here in recent days, but pending home sales, despite that, have seen the biggest increase in over 2 years in December. Now, that's an upward trend too that you're seeing there leading into a seasonally down time. So that means really good things for the spring. I think we're going to have, if this trend line here continues, we're going to have a pretty robust spring market here in many markets across America, regardless of what, if the interest rate hits 5 or if it kind of stays where it is right now in the high 6s. Okay. So another great leading indicator that we are heading in the right direction. New listings have also ticked up. In Altos Research, we cover this every Monday. They do remain obviously below these pre-pandemic levels. It's a pretty good chart here. It'll be available in BAMX for everybody. that showcases those new listings coming up, hopefully again off of the bottom, leaving those low points behind. But obviously well below really any marking we've seen since from 2013 to 2022, outside of that, COVID quarter there in 2020. So still a long way to go there. There's an incremental stepping up to get back to where this housing market should be, to be considered normal, to be considered 2019-esque. There's a lot of bricks to be laid still before we get there. It's day by day, it's inch by inch in this market. So don't get over exasperated when you hear somebody on TikTok saying 5% mortgage rates are coming when they're sitting at 6.9 today, and they've gone up the last 3 days. That there's bumps in the road. Okay. And I understand the power of positivity, but I like to be realistic. And I do think we can get to a 5 handle at moments of time this year. I still believe those floodgates that we're looking for are closer to 5 than they are to 5.9. Okay. You see us get under 5.5 for a sustained period of time in a season when people want to move, not December or November, a season of when people want to move. You will see what can feel like a floodgate off of what we felt the last 18 months. But that to me is going to take some time. And even those Fannie Mae projections don't show that happening this year. Home prices jump most in over a year in December. So again, we're seeing home prices continuing to be strong. That probably won't change much with where we're at on inventory. Here's some December 23 highlights from Redfin. Median sale price in December was $403,714. But we're going to get into affordability here in a second. Just going to be tough for some folks to buy a home. Year over year change 4%. Pending sales year over year change 5.9%. I love that sign. Homes sold down 4%. New listings year over year up 2.7%. Good indicator there. The pending sales being up 5.9% kind of, to me, tells me that home sold number is going to improve in the future. Homes for sale down 5.1%. That's one we got to start seeing some improvement on, and we are seeing signs of improving there. Months of supply in December, we had 2.6. We had 2.6. NAR says we're up closer to just under 4. Redfin's got us at 2.6. Interesting discrepancy there. Certainly know that number in your market. The Northeast is going to be much different than the West. Going to be different than pockets in the Southeast. So know that number inside and out in your market. Obviously know how to explain it. Over 6 months, under 6 months, over 6 months buyers, under 6 months sellers market. Median days on market, 43. There you go. That's the Redfin's report on top of Fannie Mae's report. Now let's take a look at. We mentioned the affordability, and this is a tweet from Lance Lambert. Steve Harney, the founder of Keeping Current Matters, he quote tweeted this in a response. I'll show them both to you. If you read Lance's, this can sound. You know why I like Lance? Because he keeps it real. We had him on Knowledge Brokers podcast a couple weeks ago. You should go check that out if you missed it. He's former editor at Fortune. Now he has started Resi Club. Must have, by the way, Resi Club. And he keeps it real. If U.S. income spiked, this is just numbers, okay? If U.S. income spiked 69%, not going to happen. Heads up, will not happen. We'd return to pre-pandemic housing affordability levels. If U.S. home prices fell 41%, heads up, not happening. Not happening. We'd return to pre-pandemic affordability. Home prices are not falling down 41%. I know they did it that one year in 2008. Totally different situation. Keeping Current Matters has done a great table on how different the 2 years are. I think I have it here in front of me, but I don't know if I can get it onto that screen. I'll just read it for you. 15 years ago, job cuts 8 million, right? Right now, none, really. unemployment's at the all-time low. I should be able to get this over to you. Hold on. I want to show you guys this. Here we go. Just do a little airdrop, Byron. I actually have Wi-Fi on up on the big screen today, which I typically never do. All right, it's sending to me 8 million job cuts, none now. Here it is. Here it is. All right. Total jobs 138 million to 158 million. Subprime loans, they were in abundance back then. You're not seeing this now. Virtually no subprime loans. New construction, you had 7.65 million units, 4.6 million in this current housing cycle. Inventory on market, you had 4 million homes. Now you have, active inventory, we're at 500,000, 1 to 1.2 million. They're using NAR's number there, which I don't love to use, but that's what they're using there. Mortgage delinquency, just non-existent compared to 15 years ago. 10.1% 15 years ago, 3.6. Homes in foreclosure, 4.6 to 0.6. So, nothing like what we experienced 15 years ago. And so to say that prices could have a chance of falling 41%, and Lance is not saying that at all. But some other people would say, well, that could happen again. No, it can't happen. 50% of housing inventory is owned by baby boomers. 40% of all homes are cash. Everybody's got a ton of equity. That's what's kept the delinquencies down. If U.S. mortgage rates fell 4 percentage points, we'd also return to pre-pandemic affordability. 4 percentage points. So he's talking about a 2.9. We're at 6.9 off of yesterday's Mortgage News Daily. Okay. This housing affordability deterioration is global. He shows here it's not just a U.S. thing. This is across the country. And as of today, we are not on a path to pre-pandemic housing affordability. We are in a historically significant chapter for housing, one that has witnessed affordability deteriorate to unforeseen levels in decades. Okay, so that's Lance Lambert just, as he does, collecting a little bit of data, putting it out there. And Steve Harney, he subquoted this and he responded. And I'll show you this response now from Steve. Steve's the founder of Keeping Current Matters, which has supplied real estate agents with such great charts like the one I just showed you for years. Please understand that this is an example of what it would take to get back to one of the most affordable times in American real estate history. That level of affordability may never be seen again in our lifetimes, and therefore should not be the expectation. Getting back to historically normal levels of affordability should be the expectation. So Steve's saying, don't go and look at what we saw with these historically low interest rates. Go somewhere in the middle, okay? And if you go somewhere in the middle, then you get those gradual spikes in income. Maybe you get home prices to flatten out a little bit, and you get that rate to come down from near 7 to that 5 that everybody's talking about, but not maybe the 2.9 or 3. Now you're in a more normalized affordability scenario. It really does come down to this rate getting to 5. I'm rooting for that to happen. I want to be clear on this. I'm rooting for that to happen. But I do see bumps in the road to get there. And so it is all about us getting that rate down. And with days like this in the last 4, it makes it harder. We're up to 4.172, ticking up again here today on the 10-year Treasury. Yesterday, we ended the day up just a smidge from the day before on the 30-year fixed to 6.89. The 30-year fixed weekly survey, though, did come in lower than the week prior, 6.6 compared to 6.66. Okay, so still can get locked in. Buyers can in the mid 6s, depending on their personal situation. But we are seeing a little bit of volatility. Haley, I don't know if we've got any questions to address. If not, I will jump off and jump into recording this week's edition of Knowledge Brokers Podcast. It'll be myself, Lisa, and Tom Toole on this week. Last week, we had Danielle Hale, chief economist from Realtor.com. Week before, we had Lance Lambert, editor of Brezzy Club, formerly of Fortune. This week, it's just going to be the home team. It's just being the three of us, but we're going to cover all things over this week. I'd love to dig in with them on some of the uncertainty in the economy that has kind of brewed up this week. And we'll obviously be able to go deeper on some of the tactics that agents should be using to turn over business. That's on a separate channel at Knowledge Brokers Podcast. Jump over there and hit subscribe. If you've been enjoying this hot sheet, please subscribe here on the main YouTube channel and consider jumping over to Apple and leaving a review. We'd love to see some more reviews on Apple this year. I know some people listen on Apple throughout the day. Love to have a review on Apple if you would consider doing that. Obviously, to get the most out of what we do at BAM, become a member of BAMX. We have a link down below for that. And we also have our Pro Bowl event on February the 7th. This one is headlined by Ryan Serhant, who I'm going to see Monday in New York, by the way. We have some content coming up for that, so keep your eyes out for that. Neil Dingra is brilliant content creator, mortgage guy. David Childers from KCM. He's going to help us break down this market. Jason Pantana, Gary Gold. Gary Gold sold to Playboy Mansion. Jason Pantana, obviously Tom Ferry. Speaker and coach Danielle Garofalo. She's a luxury expert. Marie Lee, expert content creator. Jimmy Mackin on scripts, and I'll be hanging out. We've got Eric the Broke Agent, Luca from Actually Agents, and Amanda Bradford doing the national anthem. There's a link down below to sign up for that free event on February the 7th, the first ever BAM Pro Bowl. It is going move to the motherlode. It is going to be fire. No question about it. I hope everybody has a fire weekend. I hope to see you over at Knowledge Brokers Podcast later on this afternoon when that goes up 2 p.m. on the East. And we'll be back with the hot sheet as we always are, Mondays, 9:30 on the East, 6:30 on the West. Until then, have a great Friday. Have a great weekend. And of course, toodaloo.